Welcome, everyone. This is our session on Friday, the March 22nd. A lot has happened in the market this week. Before we start, I just want to thank my colleague Rohan Singh. Both of us have been putting out daily blogs. So our blog site is chartsarefun.substack.com. You're welcome to go check it out. It's free. We appreciate if you subscribe. This way, it directly gets to you as soon as the blog is published. It's usually Monday to Friday is what the blogs are published on. And then as soon as it's published, if you are subscribed there, just put your email down. You don't have to make any commitments or any payments, nothing. Just your email down, and then the Substack site starts sending you an email with the blog as soon as it's published. We've been following a daily cadence, as I said, Monday to Friday. If you go to archive, you'll see all the various blogs that have been posted. This week was quite interesting. Several key things, especially starting the week, GTC conference, the mega developer conference of NVIDIA. Jensen Huang released their Blackwell, their latest generation GPUs. Got a lot of excitement, but then it was a classic, buy the rumor, sell the news kind of event. Tuesday morning, NVIDIA actually opened down quite a bit, touching $850. But since then, actually, the semis got a bid, and overall, the market, the technology sector, QQQ, did quite well. Before I show the weekly updates, want to also mention another service that we have, which is our YouTube site. It's called Charts Are Fun, is the channel. We appreciate your subscription. Again, it's free to subscribe. If you just hit the subscribe button when you watch our videos, just helps us share this with a wider audience. And also, if you like any of these videos, appreciate if you hit the like button as well. So right here, that's the thumbs up, the like button. And then if you want to share a comment, we do monitor it. We'd be delighted to respond back. And then the bell button is the subscribe button. If you could subscribe to our channel, it just brings in more engagement. So with that, let's talk about what happened in the market this week. It was a very interesting week. I'm basically showing the key assets. By assets, I mean, if you look at the equities, the core ETFs that track the equities, DIA, also called the Diamond, tracks the Dow Jones Industrial Average. We have SPY, which tracks the S&P 500. We have QQQ, which tracks NASDAQ 100. And then we have IWM, which is the small cap ETF tracking the Russell 2000. So those are the four on the equity side. And then with that, we added an interesting Vanguard ETF that tracks the worldwide performance. And that's the VIX US. That's everything in the world except the US stocks itself. And then, we looked at the core ETF that tracks treasury performance. It's the long-term treasury 20-year plus, called TLT. It's a pretty popular ETF. Large money managers manage bond investments through that ETF, TLT. A couple of ETFs that track commodities, GLD for gold, and then USO for the US oil. And there's a ETF for the US dollar. This is dollar against the market basket of currencies. That ETF is called UUP. And then, as we know today, as in the world we live in, cryptos, especially after the Bitcoin ETFs, is getting a lot of attention. So we have the crypto ETFs being the crypto market, the Bitcoin market being tracked through one of the largest and one of the most popular ETF that was there even before Fidelity and the IBTC and a bunch of like the other new ETFs, iShares ETFs came for crypto. GBTC is the grayscale Bitcoin crypto. So that's been around for a while. So as we look at the week's performance, interesting enough, you'll notice that the week started off, this is 18th on Monday, with Dow Jones Industrial actually gaining almost as 3% in the first couple of days. And then since then, the Dow Jones took a back seat, while right after Wednesday from 2 o'clock onwards, so from 1 going on to 2, a key thing happened. Key thing was what Powell announced, the FOMC's press release and also the press conference after that. And the key statement that the Federal Reserve did was they maintained the expectations for 3 rate cuts this year. Market was expecting 3. Originally, back in December, after Powell got extremely um, dovish in many regards with respect to saying that the tightening had peaked and it was time to cut rates. Market was even expecting as many as 6 cuts for the year. But we do know what happened in the month of January and February. The inflation data was hot for both what was released for January and February 13th, and then what was released for February in March. So Powell somehow feels that that's transitory. There is some seasonality effects. There was rents, some of the insurance premiums went up in January. He feels that that will eventually dampen out, and he still sees a glide path of the inflation coming lower towards his 2% target. He was not in any rush to get to that 2%. He felt that over time it'll get there, but it's on the right trend and the right trajectory was what he said at the press release. Market liked it. Market liked that. Market was a bit fearful after the consecutive strong inflation data in February and March, as in the January-February data which comes out in February and March, thinking that perhaps he may cut down the expectation of the 3 cuts. He did not. He kept the 3 cuts expectation, and the market liked it. So basically, from 2 o'clock onwards, so from 1, you see it was a tight range, and then it took off. The key things that took off in black line is the QQQ that actually not just took off, it maintained its gain and closed at the highs of the week. Among all the other assets, the QQQ was the strongest asset, maintaining 3%. S&P was right after. S&P maintained 2.25% gain, and very close to S&P was the Dow Jones Industrial, the diamond, maintaining 1.94. Small caps actually underperformed today in particular. It actually held on doing quite well. The magenta color IWM, it's 1.6% till, after it actually got a big rise. It was way towards the 0%, if you notice, flat for the week, small caps. And then right from the press release, it went up almost as high as 3% gain in just a span of the rest of the couple of hours of trading on Wednesday, going into early Thursday. And then Thursday, it kind of maintained the gain, but today there was a key event which happened last night. The Congress approved the 1.2 trillion bill to continue the government to be funded and passing on to the Senate to vote. And that actually helped the yields come down. And as the yields came down, it brought interesting enough, today, the banks did not do so well today. So banks like higher yields for the net interest margins. So today the banks didn't do well, and in particular, the regional banks didn't do well either. And that's the KRE index, and that's a big part of the small caps. Today, interesting enough, the biotechs didn't do well either. You would think that lower interest rates are favorable to smaller companies in the small cap sector, and so as for the biotechs, because they do need a lot of investment to do their innovations. But biotechs took a breather today, and that brought the small cap. So in fact, from closing almost above 3% right after the FOMC release, as you can see, the magenta tapered down, and today it came down, losing almost half of that gain, closing closer to 1.6%. Interesting enough, if you look at the US dollar actually got a very interesting bid. It got that bid from, it was kind of maintaining flat, and that US dollar is UUP, which is, the light gold color thing here. And it got a bid starting from yesterday. And the reason it got the bid was the Swiss National Bank cut their rates. This is the first in the Eurozone that cut the rates, and the expectation is Europe's economy is weakening. And the feeling is that there will be further rate cuts, not just in Swiss, but in the Eurozone itself. And that'll give the US economy and the dollar an edge. Also, something interesting happened yesterday. The leading economic indicator data came out. That kind of projects how's the US economy going to do several months out. And the leading economic data, actually, there was an interesting Twitter post on that. Let me just share that. You'll notice that after 23 months, each of these histogram is a month of leading economic indicator data. So you can see it kind of kept coming down all the way up till March of 2023. Since then, it has been going up, but it finally hit above the zero line. It hit a positive number. So that was an optimistic economic point about the US economy. So while there's been quite a bit of recessionary fears last year, it turned out actually to be positive. The US economy is turning around, and the LEI was actually indicating strength in the US economy. So that actually was also bullish on the dollar, and that helped the dollar actually do quite well. As we notice, the dollar UUP closed up 1.2% for the week. The laggard was by far cryptos. Cryptos took a beating going into Monday, into Tuesday morning. Then it got a bit of a bid with after the FOMC. Speculative money flows quite well into the cryptos as it does with other, stocks, and especially small caps are also very speculative. So that's just like they got a bid with Powell being dovish, the cryptos got a huge bid as well. And then right along when the small caps peaked and started going down, the cryptos also started selling off, and they recovered a bit today. But at the end of the week, it was down 7.5%. So that was the worst performing and the only asset that was negative, only as in the broad set of assets that we're comparing here. Everything else pretty much were positive. And the world economy ETF, which is taking US out, was actually positive as well, closing up 0.76. Crude oil had an interesting, there was a bit of a jump into, this is the crude oil kind of chart. So it kind of had a little bit of a jump after Powell, but then it kind of lost its gains and kind of closed closer to USO as the ETF for that, closer to 0.47%. So, and gold also had a very muted week. It's the one in green here, dark green. And it also closed towards actually in the positive column. That was the lowest in the positive column. It only closed up 0.32%. Now, if you look at the cross-sector performance, so as we know, there are 11 sectors. The only sector that ended negative for the week was actually the real estate, the XLRE. Everything else was positive. And if you look at the strongest gainer for this week, it was actually the communication sector. Meta had a crazy good week. And overall, Google, the overall, internet sector did very well. So XLC, which is the communication sector, closed up almost 3.5%, 3.48% for the week. So that was the strongest performing industry sector. And there are, as I said, 11, taking the real estate out, which is only one negative. We're showing the top 10 that performed positive gains for the week. Then after that, if you look at the next strongest sector was the discretionary, XLY. That closed up 2.84%, and that's right here. And the industrial actually was the second best, 2.88%. That's where Caterpillar, that's where all the construction companies are, GE and so on. So the industrial was second at 2.88. Right below industrials was the discretionary. That's where Amazon and others are. That's a lot of the retail stocks are in discretionary. That's 2.84. And then from there onwards, technology was actually the number 4 for this week, closing at closer to, if you can see XLK here, closer to 2.2%. And leaving the real estate out, among the positive column, the weakest sector this week was the healthcare, which, as we see, is at 0.39 now, or close to 0.4. Healthcare is where the biotechs are. That's where the large pharmas are. So we know that today the biotechs did have a pullback, and healthcare, as a result, with the pharma, that overall had a pullback as well. But overall, it was kind of the lowest performing positive sector in the U.S. Stock market this week. So with that, let's look at the long-term picture. It's very important for us to get almost like looking ahead into the future. Where is the market headed, if you ask? So this is a weekly chart of the SPY, which is the S&P 500 ETF. And what we see here is a beautiful cup and handle. So the cup started around late 2021, where we hit the highs and then we had the bear market correction. So from 463 is the top of the cup on the left-hand side. We hit 340, which is the October 2022 bear market bottom. So that was the bottom of the cup. From there, we've had a steady rise up towards the July 2023 peak, as in the right part of the cup at 454. And then we had a beautiful handle, a shallow pullback from 454 towards 406. And then we had from October of 2023, we had a beautiful rise, strong climb. A lot of that helped by Federal Reserve, Powell going dovish, kind of announcing that he had done with his interest rate cuts, interest rate increases, and time to start cutting. And that measured target is 570. So a beautiful cup and a handle. You just take the top of the cup, 454, subtract it from the bottom of the cup, 340. So that's about, 340 to 454 is about 114 to 115 points. Add that to 454, and that takes you towards closer to the 570 target. So that's where the SPY is headed. And we know that we are currently closer towards 521. So we still got another 10% to go from 520 to 570. Now, if you look at a similar target for for the QQQ, the Nasdaq 100, we also have a cup and handle pattern there. And the cup and handle pattern there was with the, again, to November. In fact, the QQQ's peak was November, while the S&P was kind of late December, early January at 401. That was the top of the left top of the cup. The bottom of the cup was 251, came back up to 385. Cups don't always have to be identically symmetrical. They kind of in the 10 to with like $10 to $15 off from the previous peak, but this like 401, 385, about $16 difference. But that's the cup. It's a beautiful, shaped cup, and then a shallow pullback, a handle, and then the breakout. So the breakout here from 385 to 251 is about close to, it's 251.5, 385.93 is almost 386. That's closer to 135 points. So if you take 135 points and add it to the 385, that's closer to 520, 520, 521. So that's where the target is for QQQ, and we're currently around 450. We touched almost 450, 449 this week, closed a little below at 446. So even if you take 450 up to 520, that's almost 70 points, and 70 points from 450, that's closer to, little more than maybe 13, 14% is where that can go to. So there is still more upside in the market. And the question is, does the market go up in a straight line? It usually doesn't. Usually at some points, the market does start pulling back. And the key thing to keep in mind here is we have hit RSI at overbought levels, but recently RSI is beginning to kind of weaken a bit. So you see that it had touched a much higher peak, then as it climbed higher, weakened a bit, and now as we are at a higher high in the price, RSI is not at that higher high. It could, negate that pattern, and it could start climbing. And if there is bullish news with respect to the economy, with respect to the company's earnings coming up in April, maybe this index could keep rising, going all the way up to the 520 target. But temporarily, this thing is a bit of a caution to look at. And also a similar kind of a pattern here with the PPO, showing that the PPO, the black line is converged, almost getting close to the red line. And that means that if it kind of crosses and goes, the black goes below the red, this histogram that you notice actually measures the distance between the black and the red. When the black is above the red, the histogram is above the positive line. When the black goes below the red, the histogram goes to a negative line. So that's when this can go into the negative territory. So that's a concern, because the negative territory means a correction and something to watch out for. Now, if you look at the same QQQ on previous one, both for the SPY, the QQQ were weekly charts. Now we're looking at a daily chart. And, when you follow trends, and when you look at channels that you can draw by connecting the lows, and you can draw by connecting the highs of a time period. In this case, every candle is a single day of trading. And in this case, we're looking at roughly the last 8-9 months of trading. So here, if we draw a channel joining the bottoms and a channel joining the tops, we can see that it has nicely climbed, hugging the channel towards the top the first couple of months. Then it came and dipped, touching the lower part of the channel, closer to the lower part, not exactly the lower part of the channel, towards early January. It rose right back up to the top of the channel, stayed towards the top towards most of February. And then more recently, as in from late February through now, we can see that it's not been strong enough to go back to the top of the channel. It's hugging and staying more from the midpoint of this channel to the lower part of the channel. So that usually is an early sign of the breakdown. Also, as this is going on, a classic way, a leading indicator to notice if a topping pattern is looking at the weakening relative strength index. And that's called negative divergence. When price keeps moving higher, but RSI keeps printing lower highs. So the high that RSI printed towards December was, you can see, closer to 73, 74, quite a bit higher than current RSIs. Current RSIs is near 60. So what's bullish about RSI is if RSI stays above the midpoint, like 50 and higher, that's a bullish pattern. And that's the fact. We are definitely climbing higher highs and higher lows. So far, we haven't broken the pattern of higher highs and higher lows. So we had hit 392 in November. Then the next thrust got it to 412 in December. The next thrust got us to 429 in January. Then we hit 458 in February. More recently, we hit a 449, which is the high yesterday. So these are higher highs. So the pattern of higher highs is very much there. And the pattern of higher lows is also very much there, right? So we had a 381 low in early December, 394 in January, 416, 4. So it's as we are, climbing, we are climbing higher lows across the board. Recently, very recently, there was a slight break of the lower low, and that was when QQQ hit 432. This was last week, and that was kind of the fear. The market was thinking that it's going to be a hawkish FOMC with the inflation data being strong, and the market was hence fearing that perhaps hawkish Fed not kind of keeping their rate cuts at 3, maybe reducing the number of rate cuts, feared the market a bit, and it kind of got a correction last week. And that's when we did see a lower low, so a slightly. So 433 was the low of early part of March, and last week we saw a lower low at 432. However, what does get invalidated is if this was a pattern of lower low, you would have expected a lower high. But the market completely loved Powell's dovish stance, keeping his affirmation of the 3 rate cuts, and it did print a higher high. So you would say the benefit of doubt is still for the bulls. Yes, there has been a lower low from the early March, but then there's been a higher high. So right now, if you say, well, is the benefit of doubt towards the bulls or the bears? You would say that, well, it is towards the bulls. Why? Because it did print a higher high. And the fact that, market seems to have bullish momentum. It seems to be climbing higher highs. And it's possible that, if we get a breakout of a 450 next week for any positive news, we could effectively go touch that up end of the channel, which keeps climbing with every day of time. The upper trend of the channel keeps climbing, so it could go towards 470. And for that matter, we know the target is near 520. Usually it takes time. It doesn't go up in a vertical line. So we do expect a pullback before it goes there. And the other thing to keep in mind is in the moving averages, the red is in 20-day moving average, and then the blue is 50. You can notice that the 20 is steadily climbing. It is definitely above the blue moving average, the 50. So that part is bullish. When a 20 is above the 50 and both are climbing, that's bullish. So until the 20 starts kind of plateauing and starts coming down, we're still not in any bearish trend whatsoever. We're still very much in a bullish trend. And though we did break below the channel briefly last week when we hit a lower low at 432, and that was on high volume, we took it up and now we are back in the channel and we had a higher high. So at this point, as I said, the benefit of doubt looking at the QQQ chart is in the reversables. Now, another thing that I have talked about before and I'm very closely watching is the interest rates, the 10-year yield in particular. This has been climbing a channel as well from December. It had, as we know, there was towards October timeframe when the market hit its low for last year, the 10-year yield had shot very close to 5%. That's when Powell was strongly saying that we're going to have interest rates higher for longer. He kept fearing that inflation needed more tightening to get controlled, and hence he was very strongly in the camp of higher for longer. The market was fearing even higher rates beyond the 5.25 to 5.5% that the current interest rates are, and hence 10-year yield shot up close to 5. Since then, it has steadily come down, and it came down quite a bit from 5% closer to 3.78%. By the way, TNX is basically Treasury yield, 10-year. TYX is the 30-year, and FVX 5 is the 5-year yield. So each basically have an X, and then TN for 10, TY for 30, and FV for 5. So FVX is the 5-year yield, TNX is the 10-year, and TY is the 30-year. So you can look at the charts of all of those, but looking at the 10-year, you can see a rising channel. And interesting enough, it has been also maintaining higher highs and higher lows. And that actually is not good. Higher highs in Treasury means interest rate expectations are heightening, or are they going higher? And that usually is fearsome to the market. Market does not like high interest rates in general. However, when the economy is doing great, you could have times when the interest rate goes higher along with the stock market going higher. That's when the economy is doing great and the interest rates are going higher because the economy is doing great. It's trying to discount the market's great growth, and that can be bullish. But in general, when you have the period of very, very low interest rates and now interest rates are going higher, for all the companies that need to raise cash for the balance sheets, that need to take debt to fund their business, it's not good because they have to raise debt at higher interest rates, and that means their cost of capital goes up. So in any way, here the key pattern is 4.36, 4.35 is massive resistance right here. So as it came back up climbing this channel, it hit that 4.35 and then it pulled right back. When it pulled back, touching 4.35 in February, and by the way, that 4.35 touched because of that hot inflation data. And then it pulled back, and then the hot inflation data came again in March from the month of February, and that pulled it back up again to test that same level, 4.35. However, with dovish Powell, and market was kind of anticipating a dovish Powell. It started this week, and each of these are actually daily. So the last 4 days, the yield has actually come down from 4.35 back towards 4.2. So now the key thing is the expectation was when this was climbing, we thought that we'd go up to the top of the channel. It actually did not. It violated that, or it stopped at that resistance of 4.35. So this week, after Powell, and especially after today, after the pullback further, got deeper towards 4.2%, there's been, like Rick Santoli, he's a very well-known CNBC columnist, covers the bond market, and others saying that, we probably hit a double top on Treasury yields. Why double top? Well, so this is the climb from 3.78 to 4.35. That's the first stop. Pull back to 4.03 or 4.04, higher low, and then back there. But here we could not print a higher high. We actually printed slightly lower value than the previous one. 43.54 is 4.35, 43.48 is 4.348. So slightly lower high, but two successive peaks and hence a double top. And now folks are expecting this to pull back deeper, go below the 4.23 and back towards the 3 handle, as in 10-year yields somewhere in the 3.8. It may even go back and retest the 3.78 from late December. That's the feeling of the market, thinking the reason being that, well, if you have a dovish Fed who keeps interest rates cuts and starts cutting rates, this will bring the rates down. And they were just pointing the double top, not just at the 10-year yield, they started pointing that at the 30-year yield and the 5-year yield as well. Double tops across the board, which means this is bullish for the bonds. Bonds will start rallying. When yields come down, it's bullish for the bonds, but it'll also be bullish for stocks. Why? Because lower yields means lower cost of capital, and market likes it, and market will, especially small caps. Small caps are very interest rate sensitive, and this could mean very, very bullish outcome for small caps if this is truly a double top of 10-year yield. Dollar, interesting enough, is printing a slightly different pattern. Usually dollar and yields are correlated. When you have higher yields, that means there's more to be earned when you park your capital in US Treasuries. So when you have Federal Reserves of US, but then you have all the central banks around the world, they take their treasury and they invest into safe haven US assets. So when they invest in treasuries and those yields are higher relative to the yields in their own countries and so on, or in Europe and other zones, that means that their capital appreciates, right? If their yields keep, going higher. But from a perspective of, and that usually correlates to a higher dollar, because money moving into the US currency, more buying interest in the US currency means relative to market basket, US will go higher. So that's the expectation. But this is an interesting pattern where if the yields are going to come down, it's rare that the dollar can keep rallying. The dollar would be actually coming down because interest rates of US are coming down. So, but the reason it actually did very well the last couple of days, in fact, this is the weekly chart from a daily view into weekly, last couple of weeks, it has been trending higher, is that even though US rates may come down, the rates may not come down as much as it'll come out in the Europe, in China, in other countries around the world where the economic slowdown is a lot worse. And the fact that the reason the dollar rallied was the leading economic indicator, indicating that our economy is in sound shape. Also, the dollar rallied quite a bit today because of the fear that what if the Congress and the Senate doesn't keep the government running if they didn't pass this bill. So the fact that that $1.2 trillion bill got voted in by the Congress yesterday ahead of the Easter vacation, and the fact that now it's looking favorable that the Senate will approve it as well, means that U.S. economy is in good shape. Leading economic indicator was good. The dollar, it was dollar friendly, and that's why we had a strong rise of the dollar. But the key thing to keep in mind is there's a beautiful cup and handle on the dollar. 28.35, pulling back to a low near 25.59 towards early 2023, back towards 28.35. That's a like symmetric, same left and right brim at 28.35, 25.59. If you take the difference between 28.35 and 25.59 and add it back to 28.35, that measures to 31.11. So that's a decent upside in the dollar if that happens. And that would not be good for commodities. Commodities are negatively correlated to the dollar. So dollar rallies, you can expect gold, you can expect oil and other commodities to have a bit of a downward swing if that happens. Also, often dollar is considered as a safe haven buying, and the dollar rallying often is correlated with the US equities coming down. However, there have been times when both the dollar and the US equities have rallied together, and that's usually when the true economic conditions are good and growth is coming in, and hence the dollar does well, so does the US equities. But usually dollar going too strong would not be very good for the emerging market, for example. Now, the other thing to be looked at is VIX. This is another indicator of volatility of the S&P, looking at where the fear gauge, also called the fear gauge, is. It has been rising a steady, this is the daily chart of VIX, a steady upward trending channel as well. But guess what happened in the last couple of days? So Wednesday was when it dipped below it after the dovish Powell. And then last couple of days, it printed a bit of a reversal bullish dojis. You could call it reversal dojis when you have a long tail in the bottom and closes back towards where it opened. So those kind of dojis are reversal dojis and bullish looking dojis. But it's possible that we are now very close to the January lows of VIX, which is 12.35. This was 12.41 later in January. Today we printed a lower low from the later in January. 12.4 was this 12.41. The next level is 12.35 from early January. And then it's possible that we could go back and retest our December lows at 11.8. And that again happened when we had a very kind of dovish Powell who came in towards the FOMC meeting in December and said, I'm done with rates. We are going to be starting to cut multiple times over 2024. So that's something to watch because VIX printing lower low and printing back and testing December is actually favorable for the equities because it's inversely correlated. When fear is abating, when your, the premiums on your puts are at many month lows. By the way, VIX directly correlates because that's the implied volatility of the S&P 500, which means when you have a VIX as low as closer to 12, it then reverts from the 12.4 and closed above 13. So that's a bit of a positive sign for the bears. There's a possibility of VIX going higher means the market coming down. And we know that seasonality, March into April, tends to be bearish. Market does get a correction and a pullback. So that's something to watch. We have to be watching the VIX next week and see if it revert back to this channel and then start climbing up and actually breaking above the 16 level towards the 20. That's something to watch. Another thing to look at is the put call ratio. This is the options equity put call. So this includes all the ETFs, the various stocks, they all fall under equity. And you look at the puts versus the calls and divide them, the put volume and the call volume and divide them for the overall. this actually has an interesting pattern that when you have the put call ratio increasing, that's bearish for the market. Market is getting bearish. Market pulls back. And when you have it declining, market is bullish. Market is expecting higher prices. So here, what we have highlighted is regions when you have positive trends in the put call ratio, higher lows, higher lows, higher lows. Each of these environments, whenever that have happened, that positive trend means the MACD histogram has been above the zero line. So you see the MACD histogram here is above the zero line. The market pulls back. The bottom panel is showing the S&P 500. That pulls back. Above the zero line on the PPO's histogram, the market pulls back. Same thing, upward trending, the put call ratio. Upward trending put call ratio, the MACD histogram above the zero line, pull back. Above the zero line, histogram, pull back. And same thing that happened last year from July to October. We are right now just for the first time printing MACD histogram above the zero line. It printed 0.304. So that's something. And then we are seeing higher lows pan out on the put call ratio from February into early March to the one from this week. And we close towards the highs of the week on the put call ratios. That's the other thing to be watching. If the next few weeks, the put call ratio starts sloping higher and this MACD histogram goes above the zero line, and for a few weeks that stays above the zero line, we can expect, like what happened here in each of the time environments, a market pullback. So that's something to be watchful about. I think now I'm going to take a break for this week. Next week, I'll talk about a very interesting pattern, which I've discussed in the past. There's a blog written about it called the bullish percent index. This measures in the index, like in this case, NDX is the NASDAQ 100, what percentage of the stocks are actually printing bullish patterns from a chart pattern called point and figure. I'll discuss it next time. It's a very exciting, and I'm planning to write a more detailed blog about it as well. It's very exciting. You can actually go to stockcharts.com. This is the chart school, and read the whole section about what is a bullish percent index. Beautifully written, great examples, explains what is a buy pattern, what's a sell pattern on the bullish percent index. And interesting enough, if you look at the pattern that whenever, just like the CPCE, this is just the opposite. When you get the bullish percent index, let's say of the NDX, print a histogram below the zero line, the market pulls back. Below the zero line, market pulls back. Right now, we've started printing below the zero line now since early February. Market pulled back only slightly, but then climbed back higher. So that was a bit of a false signal. But remember, that false signal also happened in July to August, right? From July to August, initially we got a small pullback. The MACD went below the zero line, then a slight upward trend. So it's like a stair-step decline. Pullback went up, pullback went up, and then finally the last leg of the pullback came in late October. In a similar way, we could have a stair-step pattern here. We pull back, went up, maybe another pullback comes the next few weeks in April into May. And there's a possibility that this histogram takes out several weeks to pan out below the zero line. And during that time period, we get a reasonable pullback, maybe 8 to 10% in the QQQ or the NDX, the NASDAQ 100 index. With that, I'll just end the recording here. Thank you all for your time.